Remember what Lisa said about a quiet weekend?
Excuse me.
Do you remember that earlier this morning,
no,
a quiet Friday?
You were the one that was saying, it's so quiet, it's great. You were the one that jinxed us.
It was me. I was hoping for a quiet weekend. You're not getting one. Equities are down here by more than 1% on the S&P 500. On the Nasdaq, we're down by 1.3. Over in Europe, we're down even more. Off the back of this, from the President of the United States, the European Union, which was formed for the primary purpose of taking advantage of the United States on trade, has been very difficult to deal with, and recommending a straight 50% tariff on the EU starting on June 1, 2025. The DAX is down 1.4%.
Yeah, then he goes on to say there's no tariff if it's built in the or manufactured in the United States. And then again, we have, for the second time this morning, thank you for your attention to this matter, exclamation point. So there's a real question here. What exactly is motivating some of these actions that he's taking? So
yesterday we discussed whether passing the bill through the House, the tax bill, would embolden the president to be harder on the Europeans on tariffs. And I just wonder if the two things are lining up here and if they are connected. Just giving him the space, the room to go harder on Europe on tariffs, because we are progressing this tax bill in Washington. It just highlights the point. I don't know whether that's the case, but one could easily connect the dots and come to that conclusion. There is a question about whether this market has gotten overly complacent with peak uncertainty, given that it is ongoing and we still don't have any kind of sense of what the solid goal is or what the plan actually will be. So we've got a threat against Europe. That's sending European equities south. Threat against Apple as well. Check this out. Apple in the pre-market is down by more than 3%. The president threatening tariffs of up to 25% on Apple's iPhones. The president posting on Truth Social that he expects iPhones sold in the US should be made in the US. So you've got two stories here. We're going after the Europeans on the one hand and after Apple on the other. Have you ever tried to do even small repairs on your iPhone? I've got to say, I'm not very adept at it. I don't know that I'd be very good. I'm not the guy with the skills to be doing those things. Yeah, like, or trying to make sure that the screen protector is on perfectly. There always are bubbles when I try to do it. I'm just saying, I hope that there are a lot of really skilled people in New Jersey who can do that. Jim Bianco might be one of them. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme, sir. I was hoping for a quiet weekend. We're not getting one going into this opening bow. We've got a threat against Europe, a threat against Apple. Out of the two of those, what do you think is more important to this market this morning, Jim?
Oh, I think it's probably Europe because it's a bigger market and encompasses more goods. So we're back to tariffs on. And tariff on, I think, is going to be an interesting way for the market to try and navigate this. Does that mean that we're going to see weakness because we're going to have higher prices? Or is it because we're going to have higher prices? Which one is going to be the dominant factor? Now, when we turn it to the Federal Reserve, they usually are focused, I think, more on prices. And I think that's the thing that a lot of people on Wall Street are missing, is that all things being equal, if tariffs are coming back and prices are going up, and that might be weakness, the Fed's not going to cut rates. They're not going to cut rates until they see that prices have stabilized. And right now we might be looking at more inflation. So, Jim, that take's important because I want to take you over to the move of the bond market off the back of this news. Yields are lower across the curve. We're down 8 basis points at the front end, 391. I know we're not breaking out of the new range, the range of the last several months, but still, yields are falling back. The 10 years down by 6 basis points, 447. What would your response to be to that early move, given that you think this ends up with more inflation down the road? Well, that's a knee-jerk response to the stock market falling. I think what we're seeing right now on this move. But if you were to back up and go back to, when we started talking about tariffs, there's been a trend higher in yields. And the trend higher in yields is really about, as things settle down, we're looking at higher prices. As I've liked to argue, if you look at the tariffs that were collected in April, that was 1.75% increase on the $400 billion of goods. That's an extra $7.5 billion of tariffs in April, 1.75% on the $400 billion of goods that we imported in April. Who's paying that? Somebody's got to be paying that. Now, the president wants us to believe it's going to be Walmart and Apple eating those tariffs and maybe the Chinese. But if you look at numbers like Truflation and price stats and stuff, which are these millions of prices that they check on the internet, prices are going up. The prices are going up for the consumer. And I think as that continues to happen, that reality is going to drive the bond market more than a weakness reality.
One thing that we've been talking about throughout the morning, Jim, is that this is not isolated to the United States when it comes to the yield move and some of these inflation concerns. How much is this applicable in terms of a broader inflation globally in developed markets that leads bonds globally to be less attractive in the same kind of way as they were traditionally for a price action, albeit more attractive from a yield perspective?
Oh, I think you're right. It does affect all bonds worldwide, especially developed markets, because the tariffs are pushing all these markets to do trade deals. The UK and the EU have done a trade deal as well. And so what we're seeing is the opposite of globalization, which I've become aware is now the word is segmentation. So we've got a segmentation coming in global trade. And that's going to just add frictions and add more costs. And those costs are going to show up as elevated or sticky inflation. And that's going to start to impact all bond markets. And it has been, because if you look over the last month or so, developed world bond markets have been going higher. The one exception has been China, where their interest rates have been moving lower. But their economy is in such an alarming shape right now that you could almost argue that even with these higher inflationary numbers that we have, their economy is more being driven by growth than it is being driven by prices.
I'm struck by the fact that the bond yield move is not special to the United States. It is something that is global in developed markets. The move, though, in the dollar is distinct, and it is raising a lot of concern that this could be the biggest casualty of some of the trade disagreements. We are seeing a bit of a strengthening in the dollar off the heels of this news with respect to potentially higher tariffs on Europe. I just wonder whether you think that this weaker dollar theme is going to persist, even if you do get some serious, significant increases to tariffs on some of the trading partners in the U.S. At a time when a lot of people have shrugged off some of what these proposals could do.
Well, yeah, I do. I do think that the weaker dollar will persist for a couple of reasons. One, I think it's what the administration wants. It doesn't, or it's at least it's not going to complain about a weaker dollar. And the weaker dollar isn't really bringing around talk about the end of dollar dominance or the reserve currency. It shouldn't, because there isn't an alternative to it. So they want it. And the second thing is, if you've watched the currency markets long enough, you'll realize that when these things trend, they trend much further and much longer than everybody thinks. Whenever you think the dollar is overbought or oversold, the joke is, wait till you see how overbought or oversold it's about to get. And right now, it is trending lower. And I suspect that over the next several weeks or few months, that's going to continue. Even if we get higher rates, even if we get a widening of spreads to, say, Europe or something like that, that hasn't been working right now.
Jim, I just want to finish on the equity call. The equity market, there is a playbook here. The president comes out and tries to anchor negotiations with extremes. Come out and say, you're going to face a 50% tariff on June 1. You've not been great to deal with. Does the same playbook that applied to China apply to Europe? Is this different? Have we exhausted that? Because there will be a lot of people out there thinking, OK, equity futures have gapped lower. I'm going to buy that. I've seen this movie before. Is this different?
I mean, it could be. I mean, you know, the biggest issue I think that Wall Street's been struggling with is, are tariffs leverage to get a deal, or are tariffs revenue? If they're leverage, I think most people on Wall Street would be fine with that. To get a deal, you know, to use them as leverage to lower tariffs, open up trade. But are they a form of a tax on foreigners to try and raise revenue? That has been the bigger issue that we've been trying to struggle with. When it comes to Europe, I think most people think it's more in the leverage camp, and therefore this is just a negotiating ploy. When it comes to China, I think more people are worried that it's in the revenue camp, and it's more than just a leverage play. So that's why I think that when it comes to Europe, it's going to probably be viewed as a leverage play to trying to get a deal done sooner rather than later.
Jim, appreciate your time, sir. As always, it's good to see you. Jim Bianco there of Bianco Research. Following this news from the president recommending a straight 50% tariff on the European Union starting June 1, 2025. Equities in response to that lower in the US, down even more on the continent. Up